The American economy, in fact, booming and has really been performing better than many had been expected. But we are now in a position, of course, where things could start to go badly, and a number of signs coming that things could be tougher in the coming years. We'll start with a quick snapshot of how the US economy is doing now. In the last quarter, growth was a pretty healthy 3.5%. Unemployment has been falling steadily in recent years. It's now holding at its lowest level since 1969. Crucially, wages have started growing as well. Compared to the same period last year, they're up by 3%. According to payroll firm ADP, American workers are on average earning $1 more an hour than they were a year ago. But it's also worth noting that a separate survey from the Centre for Financial Services Innovation finding that a quarter of Americans still don't earn enough to cover their basic expenses. Higher wages economically are good news, though, for the most important driver of an economy. That's consumer spending, up 4% in the last quarter. But all good things must come to an end, and this year is expected to be the peak of the economic cycle, with growth beginning to fall from 2019. Three key forecasts here from the IMF, the OECD and the Congressional Budget Office, all showing significantly lower growth in 2019. A couple of reasons for that, but one of the main ones is that the effects of the massive tax cuts passed last year seem to already be fading, and that's much faster than many had predicted. Business spending slowed down sharply in the last quarter. That's something that's worrying many economists. And crucially, the amount that companies are spending on buying back their own shares has skyrocketed since the cuts, implying that that's really where the extra money that they've gotten has gone. Now, that helps to boost share prices, but the vast majority of shares are held by the richest 10% of American households. The effect of that is still quite limited. Now, the other aspect of the tax cuts is that, of course, they have to be paid for. In the year to the end of September, the federal budget deficit rose to just under $780 billion. Next year, it's forecast to rise, on this graph in red, the forecast for the next 2 years, up to $1 trillion. That's a level last seen at the height of the financial crisis. A bigger deficit means adding more money to the US national debt. It's already $26 trillion, 12 zeros. More debt means that the US government has to pay more each year in interest, which means less money for other things like public services. Another big headache for the next Congress is going to be the ongoing trade disputes. The president has concluded a new deal with Mexico and Canada that will need to be voted on. Meanwhile, the tariffs imposed by the White House are starting to take their toll. Ford, for example, saying that it's already cost them $1 billion. And China's retaliatory tariffs are already hitting American companies, many saying they expect things to get worse in 2019. There's potential, too, for this dispute to escalate. The tariffs on $200 billion of Chinese goods are set to rise to 25% at the end of this year. With the Democrats taking the House, there are a few big economic decisions they'll have to take now. Firstly, do they support the new trade deal with Mexico and Canada? If not, NAFTA is likely to remain in place. On the issue of infrastructure, though, is somewhere that we may find the Democrats finding common ground with the White House. They might not agree with the plan that Donald Trump laid out earlier this year for a huge boost to infrastructure spending, mainly coming from the private sector, but they are likely to agree on the principles. There could be some movement on that issue. Another big dossier they're going to have to look at is whether or not to extend the individual tax cuts beyond 2025, which is when they're currently set to expire. A popular measure, but one that costs the federal government a lot of money.